Global markets are selling off in anticipation of the April the 2nd Liberation Day over in the US, where Donald Trump levies tariffs on countries around the world. It promises major volatility, and it comes in a week that also sees the likes of the jobs report coming out. So we're expecting to see plenty of fluctuations within the market. So I wanted to show you a handful of charts that are relevant to this story and talk you through the potential implications when it comes to the likes of the precious metals market, the FX space, and the indices space. Now, first of all, it's notable that we've been talking a lot about the so-called dirty 15 leading into this, and that is the 15 countries that are at the top of the pile when it comes to having a trade surplus with the US. This essentially means that it's a country that has a target on its back when it comes to Donald Trump, and he has the potential to try and increase tariffs with a view to essentially narrowing that gap. And ultimately, these are the countries that people have been looking towards as the major losers within this whole process. However, over the course of the weekend, we've been hearing that Donald Trump's now saying, well, in actual fact, we could enact tariffs across the board. By and large, most of the sort of major economies are sort of within this list. There's not that many of the major economies that hold a trade deficit with the US. The UK is one of them. So certainly there'll be a feeling of dismay within the UK in particular about the idea of, even if we're in a position where we do have a trade deficit, we're still possibly going to be hit by tariffs on our exports into the US. Now, it's notable that if you're looking at the two scenarios, they can't necessarily be equal, right? So if you have one country that already enacts a handful of tariffs on US imports and another country that doesn't, are they going to be treated equally? Are we going to see a blanket tariff across the board? Are we going to see some countries given higher tariffs than others? These are the different things that markets will try and ascertain as we come into this day. In terms of the surpluses and the deficits that these countries have, will we see tariffs in line with those rather than being in line with the tariffs that the other country currently implements? Remember, it was reciprocal tariffs day. And then it turned into Liberation Day, right? And maybe that's a nod to the idea that maybe we don't just want to be reciprocal anymore. We're just going to go hard and we want to drive business back home into the US. By and large, if the US risks a potential tit-for-tat trade war, it appears to be the case that they care more about the people within the US spending domestically than they care on people around the world spending on US goods. And that's notable. I mean, ultimately, the US holds 4% of the world's population, but 15% of the world's domestic consumption. So US consumers are overweight compared to the rest of the world in terms of their spending habits. They spend a lot more than others do. Now, that also can come down to wages. In terms of average wages, the US has the highest average wage of any major country in the world in terms of size. Countries of that size generally don't carry that kind of wage. You can have countries that are like Switzerland that are very small but very rich and they pay very good wages. But the US does stand out from that perspective. So they have the two sides, right? They have the size in terms of population that, say, China or India has, but then they have the benefit of that population also having money and being able to spend it. And certainly over the course of recent years, we've seen other countries, let's say within Europe, faltering in terms of growth. And in the US, it continues to power forward. And in part, that's because of the US consumer. So ultimately, there could be a perception that we just need to recalibrate the US consumer towards US goods. And that's going to make the US richer. Of course, that has knock-on implications elsewhere around the world. In any case, these are the countries that certainly have been talked about for the most part. And they will likely remain in the focus, in part because there's a lot of talk about essentially shifting the products that these countries create and ship to the US and creating them in the US, right? And that essentially is the problem that we have here for the likes of these countries. So in particular, Mexico, right? Mexico essentially has been an intermediary where the likes of the Chinese car makers want somewhere to be able to produce goods cheaply, but to be able to get around the tariffs. So they produce them in Mexico, they ship them over into the US, and all is well and good. Well, maybe that doesn't happen in the future. And so Mexico could be in the firing line. You've got the Irish sort of pharmaceutical industry. It's a similar kind of thing in terms of that has been a hub to then ship into the US. Is that going to be pushed back into the US? So for a longer period of time, this could play out over a period of time where there's some recalibration, but there certainly could be benefits to the US. Now, notably, what benefits the US doesn't necessarily have to benefit the US stock market. And that's because what is beneficial to US stocks is the ability to create things as cheaply as possible and sell them for as much as possible. For example, if you have an iPhone, you could create it in the US entirely, spend a lot of money, sell it for a lot of money, but ultimately your margin wouldn't be the same as if you were creating parts in different parts of the world. And the US tariffs on importing components that we saw within the auto sector, if we see blanket tariffs on goods coming into the US, then again, it will also apply on those components. And so businesses would suffer, businesses would see higher costs and potentially pass that on as well. Now, so far we have heard from Powell, who is essentially saying, if I see a one-off hit in terms of tariffs, then I'd be willing to look beyond that because I know that that's a short-term bump. But, there's a lot more that goes into it because it's not just a case of this person that previously spent, 25,000 on a car coming from Germany is now going to spend 30 or something like that, right? We also have the businesses in the US with their input prices going higher and people having to pay more because those businesses up their prices. And they also have the propensity or the potential to up prices in response to the fact that their competitors are now much more expensive. If the price of a German car goes up 25%, then a US car maker can put theirs up 10% and they'll still be very competitive in terms of their prices. So inflation is certainly a major concern here. Now, like I was saying, we do have this big focus on the US consumer, in part because they've been so strong, right? So when you're looking here in the post-pandemic period, in Asia, beyond China, many of the countries have increasingly leaned on the US in terms of selling their goods, right? So exports into the US as a sort of percentage of their output, less so reliant on Europe, less so reliant on China, more so the US. And in part, that's because of the strength of the US economy post-pandemic in relation to Europe, which has struggled, and China, which has continued to struggle. It's all been about the US. So that push towards US consumers, well, that boost might sort of start to come back to bite these countries. They might see a reversal of that boost and have to try and recalibrate towards countries like China, countries like Europe, or regions like Europe and the UK that previously haven't necessarily done all that much in terms of their spending. The spending habits aren't necessarily the same as the US. The wages aren't the same. The propensity to take on credit and debt to be able to pay for items like cars isn't necessarily the same. But nonetheless, there could be a recalibration. And this highlights the potential weakness we see in Asia. And certainly more recently, there has been a big focus on, US stocks are the ones that are going to be hit because we could see higher inflation in the US due to tariffs. And also we could see stagflation because we see weakness in terms of the growth picture as businesses essentially hold off on investment decisions. Yes, as businesses potentially are hit with higher prices and therefore they are less profitable or they hire less people as a result. So these kind of things feed into the growth side of things. The inflation side of things are impacted by what's happening in terms of tariffs. So the stagflation story is real, but it has been driving significant underperformance for US equities. The long-term trend, of course, is outperformance for US equities. But certainly as we move forward, some of these Asian countries are particularly going to be feeling the pinch. They're not the only ones. And like we said, there's countries here that are likely to be hurt over the course of this period as they try to recalibrate things. There's countries within Asia that have been gearing towards the US consumer, and that might have to turn around if some of that business goes back to the US. And then you can see here the main sort of average tariffs for some of those countries that have a major surplus with the US. And you can see here, what are the areas, if you weren't necessarily just going to see a blanket tariff, if we were going to see 10% all round, that wouldn't necessarily make sense for South Korea or India, because they have tariffs on US goods that are higher than 10%. Again, it doesn't make sense for other countries that have zero. So, it certainly wouldn't be reciprocal if they do this blanket tariff, but, it remains to be seen exactly how it will play out. These are the areas that you're likely to see impacted if you see reciprocal tariffs, where essentially enacting tariffs that are equal to the size of the other countries' tariffs that are implemented on them. And the idea of reciprocal tariffs was actually a one that seemed relatively decent in the first place, because it was the idea of, if we do what you're doing to us, then in actual fact, down the line, you can drop yours, we'll drop ours, and then it'll be free trade. But it feels like things are adjusting on a daily basis. And so this is starting to turn around into the US thinking, how much money can we make off of enacting tariffs? You look at the value of those goods, and then you think, if we were to enact a 10% or 20%, then how much money could we make in tariff revenues? Failing to recognize the fact that people are probably going to buy less. And especially if the stock market continues to tumble, if we see the economy weakening, then people are just probably going to buy less anyway. But certainly this is, from a wider perspective, you do have really significant knock-on implications in terms of growth. And that's why we've seen at the beginning of this week, around this talk of the 10% tariffs, we've seen mining stocks really hit hard as well, in part because of the possible implications for global growth and global business activity. Car exports, this is an area that already has been touched on, but really you're seeing some of these regions that are already being hit quite heavily, and some of those countries that are in the firing line because of the trade surplus. And so, a lot of these countries, the car industry is really the backbone of the trade surplus, but you can see certainly some of the countries that are potentially going to be hurt by these auto tariffs. Now, there's two ways of looking at this thing on Wednesday, right? Number one, you could point to it as the potential bottom for the market. Why would it be the bottom? Well, it's the point at which the markets are most fearful. We're fearful of collapse in terms of global growth. We're fearful about what could happen down the line, a tit for tat. It keeps getting worse and worse and worse. We're fearful about the possible implications in terms of inflation. All of these things add fear, right? But as we can see here, in the UK, we're racing to agree to US trade deal. I don't necessarily think that the end game is just tariffs forevermore. I would like to think that it is the basis for negotiations. That could take time, but ultimately, if we start moving in that direction, markets will price accordingly, right? And so the argument for it to be a bottom are based around the notion that this essentially kickstarts trade deals around the world. It kickstarts the ability for other countries to promise to buy X amount of products from the US. That's how China got around it last time. Or for the other country to drop their tariffs. That's best case scenario. The flip side of it is what's happening at the bottom, which is they had a productive call between Mark Carney and Donald Trump, but the tariffs are still coming, and the Canadians have said, well, we will hit you with tariffs on the same day. So that points towards some countries certainly going down the route of a tit-for-tat trade war, and that certainly isn't any good for market sentiment. So it's a little bit for both sides of the argument. That's why it's quite difficult for us to ascertain exactly what the implications will be. You can say within the one day that he makes the announcement, you're not expecting to see suddenly all of these countries come out and say, oh, we've struck a trade deal, or it's fine, we're just going to roll over and immediately drop our tariffs. They'll probably try and push back to an extent. So I'd expect to see volatility for the near term anyway. And certainly given the fact that we're seeing jobs data coming out later in the week, I'd also give a nod towards the ISM manufacturing and services PMI numbers. I think they're going to be particularly important because they also include the prices element, which highlights whether we're seeing stagflation, because you can see output and you can see prices within these sectors. So that's going to be really key as well. But there's arguments on both sides. I wouldn't necessarily say it's going to be the absolute bottom. Inflation is a key part of the concern at the moment. And as we can see here, we're starting to see goods inflation start to turn upwards. Goods inflation has pretty much been non-existent over recent years, but it is showing signs of life once again. And you can see here, it's been a services-led problem thus far, the inflation issue that we've seen over recent years. But goods inflation could be coming back. And that's where we start to become quite fearful about a resurgence in price pressures because of what it could do in terms of the central bank. Now, like I said, we have heard from the Fed, and they've said, you know, if we do see inflation, maybe it could be temporary in nature and we could look beyond it. That may be the case. But if we see a dramatic rise in terms of inflation and we see signs that this isn't a temporary thing, then it's going to likely rein in what the Federal Reserve are willing to do. So let's look at some charts and we can talk around them and how they could be sort of implicated in all of this. So first and foremost, let's talk about, let's just jump on this, which is a highlight of the FX markets at the moment, right? Granted, all of these colors are the same, which is not ideal, but nonetheless, let's just talk around it, because essentially we're talking about the countries that are potentially going to be hardest hit, because you've got Korea, you've got the Eurozone, you've got Japan, you've got China, all of those sort of, you know, the big dirty 15 countries, so to speak, that really benefit from trade with the US, that is in its status quo and could be hit. What's notable here is that we have been seeing a decline in terms of the US dollar over recent months. More recently, we've been seeing that pick up somewhat. And you can see that it essentially means that the dollar's rising against these key currencies, which would make sense. Ultimately, there's some risk coming into play for these countries. And so the dollar weakness story is sort of taking a breather, but it's not necessarily massive for all of them. And you can see dollar yuan sort of continue to sort of trickle lower. The euro and the yen rising a little bit, but starting to roll over a bit. You know, the dollar against the Mexican peso, that has been regaining ground. I mean, the standout performer here is the Korean won. So you can see here that you're looking here at a chart that still looks relatively at risk of further downside, potential for further dollar weakness. Now, playing into that is this, right? Which is that we have the US 10-year yield that is collapsing once again and potentially breaking lower on this news. And we saw it on Friday. We're seeing it again now. And so the pathway lower for the 10-year seems quite clear at the moment. And that's something that Donald Trump's aiming towards, driving down the cost of borrowing. They have a huge amount of debt that needs rolling over this year. And so I think there is a good chance we do see further downside for the 10-year. And you see this close correlation between the dollar index and the 10-year. And that, to me, points towards further dollar weakness. So irrespective of what's happening in terms of the threat to these currencies, I think there's still a good chance that we see dollar weakness in line with the downside for the US 10-year. And when you see weakness in terms of equity markets, as we're seeing at the moment, you see people heading towards the havens. That can be gold, that can be treasuries. And when you see increased demand for those treasuries, so the rate that you get in return goes lower, which is why we're seeing this 10-year yield moving towards the downside. So weakness in terms of the 10-year playing out at the moment, with these fears really coming into play once again. That points towards weakness in terms of the dollar. Of course, like I said, we don't necessarily know whether we're going to come out and suddenly start to feel optimistic around this announcement. Maybe he doesn't enact global tariffs. Maybe it's not as bad as we thought, and it could be targeted in nature. And if that is the case, maybe we see this hold up relatively well. But if we see a sort of risk-off move, you would expect to see 10-year lower and also the dollar lower, which is not necessarily the usual thing that we're used to, which is dollar weakness in the face of risk within markets. Generally, it's perceived to be a haven. And instead, we're seeing the likes of the Japanese yen coming into play as a potential haven. It's starting to roll over a little bit here, but you can see a massive collapse for the Nikkei 225 that we've seen at the beginning of this week, down 4% as we kick off a fresh week, in part down to the weakness that we're seeing in terms of the yen and the fact that it's starting to roll over, but also down to this news around the tariffs over in the US. So the Japanese yen, if we see it strengthen, that points towards the possibility of the Nikkei 225 rolling over in a very dramatic manner. Now, you can see over the years, the Nikkei 225 has benefited from weakness in the Japanese yen as their goods become cheaper worldwide. Well, if we were to see this market roll over, if we see the 10-year yield continue to decline in the US, if you see the US dollar weakening because of that, if you see dollar yen weakening because of that, then it points towards the Nikkei 225 continuing to decline. So that's another area to be looking out for. If you're looking at potential equity market weakness, if it comes alongside weakness for the 10-year yield, you're likely to see overwhelming downside here for the Nikkei 225. So certainly a key one to be looking out for, as is dollar yen. Now, the flip side of it is the likes of gold. Now, gold has hit its fourth week in a row, is it? Third week in a row of record highs. And wait, yes, it's fourth. Sorry, I had it on the daily. So 4 weeks of consecutive record highs. And in actual fact, we're pretty much doing it on a daily basis, right? 3 days in a row. And we had a breather before that. And it was like 1, 2, 3, 4, 5, 6. So 6 out of, no, because then we had that move there. Nonetheless, essentially, you've seen over the course of the past few weeks, we're consistently creating record highs here for gold. Now, there's going to be a number of drivers behind this, but essentially, gold is very well positioned right now to play the role of the haven. The haven where the US dollar is concerned doesn't appear to be showing up there. Instead, people looking towards the likes of the Japanese yen, the likes of gold. And gold also has the benefit of when there's a trade breakdown, so we're talking about tariffs, you know, some people might want to get into the US 10-year, but you've got risks around the US economy right now. You've got the fact that people aren't feeling all too positive about their sort of international relationships with the US. And so what we've seen is a divergence globally towards gold, towards the US yields. So essentially, we've got a very clear-cut trend. It's been playing out for months and months now, and set within a long-term trend. It is essentially part of that, right? You have these boom periods that last for years. You see retracement periods. You can see long-term consolidation periods, but you see these long-term boom periods, right? Look at this, right? So the lows back in here in 2001, it stopped in 2011, right? So a decade of strength here for gold. We then see all of this, and now we've broken higher. So people are saying, you know, how high can it go? You know, oh, are we going to hit 3,000? Look, ultimately, we have previous when it comes to extended multi-year gains for gold. And right now, it feels like we're in the middle of that. And certainly everything that's playing out is playing into the hands of gold. A breakdown in trade relationships, pushing people away from the US and more towards different haven assets. Risk off sentiment taking hold, the possibility that central banks might have to step in, the possibility that the Federal Reserve might ultimately provide QE as a source of demand for treasuries, but also to lift markets and the economy. There's plenty that goes into it. And so at the moment, you know, I think it's just a case of looking out for this near-term trend and looking out on, say, the 4-hour chart and seeing, you know, are we continuing to create our highs and lows? As long as that's the case, then, you know, for me, I think any pullbacks are likely to be playing into the hands of the bulls that very clearly remain in charge as things stand. And then I wanted to touch on, here we go, touch on the indices space. So US indices have been underperforming massively. You can see that over recent months. Let's just go this year so far. There we go, year to date. So we can see here the Nikkei 225 and the Nasdaq pretty much neck and neck here. Essentially, both of them down 10% since the start of the year. Two areas of outperformance have been China and have been Germany or Europe. So the top end of this, the Hang Seng up 17.85 over the course of this year thus far, and the DAX up 10%, right? I mean, there's a story for both, as it's well known, with the Asian, well, Chinese-centered markets. The Hang Seng is essentially the primary way for people internationally to invest in Chinese stocks. And that's why I know it's Hong Kong, but essentially it's more of an international focus in terms of the investors within it. When you're looking at Shanghai and Shenzhen, that's more sort of domestic investors. And so this is a flow from US assets into other areas that people think are have a greater chance for growth. And China at the moment, of course, we've had the DeepSeek news. We've got the fact that the tariffs that Donald Trump has initially announced fell a little bit shorter than some had expected. You're seeing stimulus plans from the Chinese. You're seeing them pledging to hit 5% growth once again. So there's been some good news, but that's starting to falter. And the same kind of thing in Europe, right? So we've, of course, been talking about a ramping up in terms of defense spending. We've been seeing the Germans shifting their rules about their deficit. So all points towards increased spending, and that should lift demand for businesses within those regions. In the US, it's quite the opposite. It's about driving down their spending from the sort of government sector, and it's about tariffs, which are likely to hurt businesses within that region. People don't necessarily have greater certainty. They're going to have higher costs and the like. And then you've got the Nikkei, which really tallies up the fears of tariffs without necessarily seeing the stimulus that you're seeing from these other two countries at the top. And then you've got the sort of strengthening of the Japanese yen to put the sort of final nail in the coffin. And that's why we're seeing that playing out in a much a similar way to the US markets. And the Nasdaq, the reason why I pulled that up, essentially, the Nasdaq is always going to be at the front and center of any major sell-off generally, because they're the most highly valued stocks. And so when they're sort of overvalued to market, then you can see a significant kickback. It's been essentially the place to be for investors over recent years. And we can see that, let's look at, say, the 5-year. Nasdaq's probably at the top of that. Yeah. So Nasdaq up 200% over that 5-year period, not so long ago, now up 155. So pulling back pretty dramatically of late. How are things going to play out? Well, what we've been seeing over the course of, let's go back to a year-to-date view. What we've been seeing recently is the rolling over of these two markets, the Hang Seng and the DAX. And that's because they have run up quite a bit on stories that essentially don't have legs, right? Like there's going to be a certain amount of longevity to that upside, that positive sentiment for those markets, before we then start to see the bears worrying about what's happening on Wednesday. And so I think there's a good chance that we do see continued weakness for those markets alongside the likes of Nikkei and the Nasdaq. I think leading into the announcement, you're likely to see risk-off sentiment continuing to take hold. And then around the announcement, of course, we don't necessarily know exactly what's going to happen. Is it going to be everyone? Are we going to see him come out with, the UK's already trying to stave off this potential imposition of tariffs. So will we immediately start to hear about certain countries have managed to get beyond it, and that starts to lift sentiment, and they then believe there's an end to this, and ultimately it's going to be a short-term thing, and countries are going to come to the table, they're going to find agreements, and that's what's going to draw this to an end? Or does Donald Trump just say, no, these are the tariffs and we're not going to be budging on it whatsoever? So lots to pick through. Certainly there's some things that have greater clarity than others, and ultimately we don't necessarily know exactly what Donald Trump's going to do right now. One major risk here is inflation. If inflation is kicked off globally, then that's a major problem. It ties the hands of the central banks at a time when the US government could be pulling back on some of their spending. And so, yeah, inflation is going to be a key one. And certainly given the fact that Donald Trump is apparently furious with Putin, who it appears doesn't really care for a peace agreement, but instead probably utilized those sort of fake agreements to push back against Ukraine and take more of their land. Do we see any sort of movement on that front? Because as it stands, Donald Trump's talking about the possibility that he will enact tariffs, additional tariffs on any buyers of Russian crude. If we see more tightness in the crude market, then you're talking about inflation coming back up on that front as well. So plenty of fear within the market at the moment. I mean, ultimately it's playing into the hands of gold, and I think it probably likely still will do. I don't necessarily think that we're going to see a resolution on Wednesday, but certainly the severity of Wednesday's announcement, alongside whether we see other countries coming out, like seems like Canada will be, with a statement saying that they will immediately enact, a certain policy in terms of tariffs on US imports, or whether countries start to say, well, we've spoken to him and we feel good about this, we're going to either drop our own tariffs or come to an agreement with the US, blah, blah, blah. It's going to be easier for countries like the UK because they already have a trade deficit with the US, whereas some of those regions that have major surpluses, it's not necessarily going to be an instantaneous fix. So major volatility this week, big uncertainty, and there's plenty of markets that are going to be impacted. As ever, risk management will be key when it comes to trading these markets. But traders love volatility, and that's exactly what we're getting right now. I hope this has been useful. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.